In options trading, understanding gamma is crucial. To truly grasp the concept of gamma, let's delve deeper into the intricate world of option trading. We'll start with the basics. Options trading, a form of derivative trading, involves buying and selling options, which are contracts that give the holder the right but not the obligation to buy or sell an underlying asset at a predetermined price. But where does gamma fit into this equation? Gamma, in the context of options trading, is a measure of the rate of change of an options delta for a 1-point move in the price of the underlying asset. Simply put, it gauges how much delta will change given a particular move in the underlying asset. It's a second-order Greek in options trading, which means it measures how the delta of an option changes as the market price of the underlying asset changes. Now let's put gamma into perspective through an illustrative example. Imagine a stock option with a high gamma. As the stock price moves, even slightly, the options and thus its value changes rapidly. This accelerated change can be somewhat of a double-edged sword in the volatile world of option trading. It can work for or against you as a trader, depending on your ability to manage risk effectively. A significant advantage of a high gamma is that it allows the price of an option to react more to changes in the price of the underlying asset. So if you have a call option and the price of the underlying stock rises, a high gamma will result in a larger increase in the option's price. However, the opposite is also true. If the stock price falls, a high gamma lead to a larger decrease in the option's price. But fear not, savvy traders can and do benefit from gamma by employing specific strategies like gamma scalping. This advanced trading strategy involves adjusting an option's position frequently to profit from the changes in the delta caused by the movement of the underlying asset. It's a method typically used by professional option traders who can monitor and adjust their positions continually. By constantly adjusting their positions in response to market fluctuations, traders can strategically take advantage of gamma and the ever-changing market conditions. Gamma scalping can be a highly effective strategy in volatile markets where the price of the underlying asset is moving significantly. It allows traders to capitalize on small price movements, which can potentially lead to substantial profits. In conclusion, gamma plays a pivotal role in options trading. Its impact on the delta and in turn, the value of is significant and can be harnessed effectively with the right strategies and risk management practices. So, if you want to navigate the often volatile seas of options trading successfully, understanding and leveraging gamma is essential. Like and subscribe for more valuable insights on trading strategies.